What's up, YouTube, and welcome back to Not Dumb Money. Today's video is special. Not only am I going to talk about the first stock I ever bought, but I'm going to do so with a friend.
Hey guys, it's great to be here.
This is the first time the two of us are working together, but I hope this will be the beginning of a long-running bull versus bear series. So in today's video, we're going to talk about Apple. I'll talk about why I've always loved the stock and why it's still in my portfolio today.
And I will talk about why you should avoid the stock. Not just avoid it, maybe even short it.
But before we get started, please subscribe to my channel if you haven't already. That would be amazing. Alright, so let me start by telling you a little bit about Apple. Apple was founded in 1976 by Steve Jobs, Steve Wozniak, and Ronald Wayne. Their first product was the Apple I. In 1977, Ronald Wayne sold his shares in Apple back to Jobs and Wozniak for $800. That same year, Apple released the Apple II. Apple went public in 1980. In 1984, Apple launched the Macintosh, which did not sell as well as the company had hoped. Steve Jobs was pushed out of Apple in 1985. The years that followed were largely uneventful, and in 1991, Apple unveiled the PowerBook. What followed were some of Apple's most difficult years. They tried unsuccessfully to introduce a variety of consumer products, such as digital cameras, CD players, speakers, and more. They invested so much in the Newton, but that never took off. While Apple was struggling, Microsoft was gaining market share with Windows. Apple tried to sue Microsoft, claiming Windows was too similar to their operating system, but they failed. In 1997, with Apple weeks away from bankruptcy, they bought Next. And with Next, Steve Jobs was back. In 1998, Apple released the iMac. In 2000, we saw iTunes. In 2001, Apple opened its first retail stores. And later that year, they introduced the world to the iPod. In 2007, Apple debuted the iPhone. The App Store launched in 2008. In 2010, we saw the iPad. 2011 marked the end of an era at Apple, when Steve Jobs passed away. Tim Cook took over CEO and continued growing Apple's product line with new iPhones, iPads, MacBooks, and iMacs. We saw the first Apple Watch in 2015 and the first AirPods in 2016. In 2018, Apple became the first company to surpass $1 trillion in value. Today, Apple has the world's largest digital ecosystem across its devices and software. And this year, it's been trading places with Microsoft for the title of the world's most valuable company.
Blah, blah, blah. Most of the world uses PCs running on Windows. MacBooks and iMacs are for students and graphic designers. There's nothing special about the iPhone. Android is better and cheaper. AirPods? Really? Such overpriced garbage. And the Apple Watch? Don't get me started. And the App Store? Come on. Developers will lose patience with Apple and will move to other platforms.
Today, we celebrate the anniversary of the platform unification directives. For years, they have given us their songs, their labor, their dreams. In exchange, we have taken our tribute, our profits, our control. This power is ours and ours alone. We shall prevail.
Apple's story sounds nice. That's why they made a few movies about Apple and Steve Jobs. Style over substance. And let's get into some real numbers here. Let's talk about the stock today.
Yes, let's talk about the stock. Apple, based on fundamentals, is a lot cheaper than many of the other tech stocks out there. Sure, Apple is not growing as fast as some of the others, but it is growing. And there's always high demand for its flagship product, the iPhone. Apple is doubling down on an affordable iPhone. This will help with its market share. We should also see a large upgrade cycle to Apple's next generation iPhones when 5G becomes more mainstream. It's not just the iPhone. iPad and Mac products have witnessed high growth. Wearables. That's where the Apple Watch and AirPods are growing. Its services such as Apple TV Plus, Apple Pay, and others are also growing fast.
Sure, Apple is making cheaper iPhones, but this just means their margins will take a hit. Apple is behind other manufacturers in adopting 5G. The company's grip on the App Store is being investigated. Can you say antitrust? Oh, and Bank of America Securities just downgraded their stock this month from buy to neutral. Come to think about it, given where the stock price is today, there's not much upside left. Just look at what analysts at UBS, Morgan Stanley, Credit Suisse, or Citigroup are saying. More than 30 times earnings? Are you kidding?
Look, numbers don't lie. Apple just delivered revenue and earnings that beat estimates. They announced a stock split. This will make the stock more accessible to a broader base of investors. Services revenue was at record levels earlier this year. iPad and Mac sales surged 25%. We are still seeing high growth, and Apple stock is attractive compared to its historical valuations and the valuations of its peers. The price-to-earnings ratio is in line with peers, but its price-to-earnings-to-growth ratio is lower than its peers. That's the ratio that matters here, because it considers growth. Not only is Apple still growing, it's doing so while maintaining a profit margin of more than 20%. Apple has a lot of cash that it can do a lot with. It pays dividends.
The stock split makes no difference to the value of the company. Many brokers today give investors the opportunity to buy fractional shares, so there's no merit to the argument that a stock split would make the stock more accessible. Apple has lost market share to Android over time. That's a fact. As for upgrades tied to 5G, Samsung and many others have already released 5G cell phones. As usual, Apple is late to the game. Their technology is inferior, and users will eventually catch on. Sure, it pays dividends, but what can you do with a yield of less than 1%? More than 30 times earnings and more than 30 times free cash flow is expensive. It's too much for a company that, at best, will grow at 10 to 12% over the next few years. I don't like that cash pile either. If they have nothing better to do with it, they should give more back to the investors.
Well, despite having so much cash on their balance sheet, their return on assets and return on equity is second to none. Their return on assets is almost 18%, and their return on equity is a whopping 70%. That's impressive no matter how you look at it.
Let me break it down. Their revenue growth over the past 5 years is just 7%. Their earnings growth over the past 5 years is just 13%. These are not the kind of numbers you need when you pay more than 30 times earnings and more than 7 times sales. Sure, the stock has been growing, and investors are happy now, but that makes no sense to me. Markets will realize that Apple stock is overvalued, and the price will eventually drop.
Well, I don't think so. I guess we'll have to agree to disagree here.
No, we're just going to have to wait until I'm proven right. The one thing we can agree on is that you should subscribe to this channel.
Yeah, okay. Well, let's wait and see. Now, this was fun, but that's it for now. Thank you so much for watching. What do you think of Apple? Are you bullish? Are you bearish? Let me know in the comments. And if you enjoyed this video, please do me a huge favor and hit that like button, subscribe, and turn on the notifications bell. As always, it's been a pleasure. Much love. Peace.